Hello. The biggest question I get now is this a correction? Are we entering a bear market? So let's look at a little history. Since 1947, there have been 12 to 15 bear markets. Bear markets since World War II averaged a 33% decline and lasted about 14 months. On the other hand, corrections declined about 13% and had a 4-month duration. So let's see what happens. And here are the factors I consider. Number 1, economic recessions. We're going to go in depth in each of these. Number 2, monetary policy. Number 3, financial bubbles. Number 4, political shocks and internal crisis. Number 5, banking and credit. And then finally, corporate earnings. So let's drill down. Number 1, the most consistent factor in determining whether we have a correction or a bear market is gross domestic product. Right now, while GDP is slowing, unemployment, however, remains strong and consumer spending remains strong. So when you look at the past bear markets, 73, 74 was Arab oil embargo that caused a recession. 2007-09 was a real estate crisis. We have neither of those now. All right, number 3, monetary policy. Right now, the Fed is in a loosening cycle, not a tightening cycle. So, am I concerned about the Fed raising rates? Not at all. Number 3, and you can see, by the way, 1980-82, the last real big market we had that went down was when Paul Volcker raised rates up to 21.5%. Financial bubbles. Current outlook, although there's been substantial gains in the technology sector, nothing like we saw in 2000 to 02. Back then, the dot-coms, no earnings, no products, no sales. We're nothing like that today. Go back to 73, 74. There was some overvaluation, but that also coincided with the Arab oil embargo, so not a factor. Number 4, political shocks and external crises. This is the area causing concern. The length and effect of tariffs at this point are unknown. However, tariffs are nothing along the magnitude of what we saw in 73, 74 with the Arab oil embargo, or in 2000 to 09 in the real estate and banking crisis. We're not there. Number 5, banking and credit crisis. The banking industry is on solid ground. Credit is slowing, but not a factor. Nothing at all like the 2007 to 09 financial crisis. Lehman Brothers, Bear Stearns, a number of major firms went down. The banking industry was in turmoil. We're nowhere near that today. And then if you go back before that, go back to 1987, Black Monday, Rothschild went under. Again, nothing of that magnitude today. And finally, corporate earnings decline. Currently, as of the fourth quarter 2024, that's a typo, should be 24, 77% of the S&P companies have beat expectations. We are just now in the very early stages of the reporting earnings for the first quarter of 2025. So this was not like the 2001-02, the dot-com, lots of people ran out of money, or the stagflation-related 73-74. So where are we now? Number 1, recession fears are declining. Number 2, monetary policy, not an issue. Number 3, financial bubbles and overvaluations, not an issue. Number 4, this is the only area of concern, geopolitical shocks and external crises. It's the tariff issue. Number 5, the banking and credit crisis, not a factor. And finally, corporate earnings declines not occurring. So let's put it all together. On the left side, corrections most commonly transition into bear markets when you have multiple factors. Single factor corrections, like geopolitical scares or policy shifts, i.e. the tariffs, tend to recover unless compounded by other economic issues. Then you go on to the right, the major drivers, recession, not a factor. Aggressive Fed tightening, not a factor. Overvaluations, not a factor. Geopolitical shocks, that's our area of concern. Banking and financial, not a factor. Earnings decline, not a factor. When you put this all together, This has all the classic earmarks of a correction in an ongoing bull market. Well, that's really the summary. I wanted to let you know what's happening. If you've got any questions on your portfolio, call us. Otherwise, remember, we're here looking out for you.